everyone, welcome back to the channel. We've all heard it before. Someone claims they can predict the next market crash or know exactly when to buy and sell. But the truth is, even the best investors can't consistently predict the stock market. In today's video, I'm going to break down 15 reasons why predicting the stock market is nearly impossible and why it's better to focus on long-term strategies instead. Let's jump right in. This is Wealthilocity. Here you create, protect, and grow your wealth fast. Reason 1. Market sentiment is highly unpredictable. One of the biggest reasons you can't predict the stock market is because of market sentiment. Market sentiment reflects the collective attitude of investors toward a particular stock or the market as a whole. It's driven by emotions, fear, greed, optimism, and panic, which are difficult to quantify. News headlines, rumors, or even a single tweet can cause dramatic shifts in investor confidence. Because sentiment is based on human emotions, it's impossible to predict with any accuracy. What seems like good news can trigger selling, and what seems like bad news can lead to buying if it contradicts the general expectation. Predicting when and why millions of investors will feel one way or another is like trying to forecast the mood of an entire city, ever-changing and highly volatile. Reason 2. Economic indicators are not always reliable. Many people try to predict the stock market using economic indicators like GDP growth, unemployment rates, or interest rates. While these can provide a general sense of the economic environment, they're backward-looking and don't always reflect the current state of the market. Even worse, they don't account for how investors might about these indicators. The stock market is a forward-looking mechanism, meaning it often reacts to what investors will happen rather than what happened. For instance, good GDP growth might already be priced into stocks before the data is even released. By the time an economic indicator comes out, the market may have already moved on, making predictions based on these indicators less useful. Reason 3. Geopolitical events are impossible to forecast. Events like elections, trade wars, political unrest, or military conflicts can cause massive swings in the stock market. The problem? No one can reliably predict when these events will happen, how long they will last, or what their long-term effects will be. Geopolitical events often come out of the blue, disrupting the market and making existing predictions obsolete. For example, a surprise election outcome can lead to policy changes that were not accounted for, causing markets to swing unpredictably. Even professional analysts struggle to incorporate these risks into their forecasts, making it a near impossible task for individual investors. Reason 4. Algorithmic trading creates unpredictable movements. A significant portion of today's trading volume is driven by algorithmic trading, where computer programs automatically buy and sell stocks based on complex mathematical models. These algorithms can react to news, data, and even other algorithms in milliseconds, creating massive price swings in very short periods of time. The problem is, algorithmic trading creates movements that are too fast for human investors to react to and often too complex to predict. It can lead to sudden price spikes or drops that are completely detached from underlying fundamentals, making the market seem chaotic and random. Trying to predict a market heavily influenced by machine-driven trading is like trying to guess the moves of a chess computer. You're always one step behind. Reason 5. Human psychology affects market behavior. The stock market is ultimately driven by human decisions. Fear, greed, overconfidence, and panic all play a role in how people invest, which means the market doesn't always behave rationally. A single piece of news can send people into a buying or selling frenzy, causing prices to move in ways that have nothing to do with the actual value of the stocks. Predicting human behavior is one of the hardest things to do, especially when large groups of people are involved. Even if you know all the economic data and trends, you still can't predict how people will react in real time to unexpected news or changes in the market. This emotional element introduces a level of unpredictability that makes forecasting extremely challenging. Reason 6. The market is forward-looking. The stock market doesn't react to what's happening now. It reacts to what it to happen in the future. This means it's always one step ahead, reflecting future expectations rather than present realities. By the time you react to a piece of news, the market has likely already moved on. This makes it nearly impossible to predict short-term movements. For example, a company might report great earnings, but if investors expected even better results, the stock could actually go down. Trying to predict short-term moves is like trying to read someone's mind. It's constantly shifting and hard to pin down. Reason 7. Randomness and noise overwhelm signals. The stock market is filled with random noise, small, unpredictable price movements that don't have any clear cause. These random fluctuations can create patterns that seem meaningful, but are actually just the result of chance. It's easy to get caught up in thinking you've spotted a trend when you're really just seeing randomness. Acting on these false patterns can lead to poor investment decisions and unnecessary trading, which erodes returns through fees and emotional stress. Reason 8. Insider information is rarely available to regular investors. The stock market isn't a level playing field. Insiders, like company executives, board members, and major institutional investors, sometimes have access to non-public information that could affect stock prices. This privileged knowledge allows them to make informed decisions before the news is made public. Regular investors don't have access to this insider information and are often left in the dark until the news becomes public, by which time the market has already reacted. Without access to this key information, predicting market movements is like trying to put together a puzzle with missing pieces. This informational disadvantage means you're always a step behind those with insider access. Reason 9. Historical data doesn't guarantee future results. One common approach to predicting the stock market is to analyze historical trends and patterns. While history can provide insights, it doesn't guarantee that those patterns will repeat. Economic conditions, technology, and investor behavior change over time, making historical data an unreliable guide. Relying too heavily on historical data can lead to false confidence. For example, just because a particular pattern has predicted a bear market in the past doesn't mean it will do so again. The market is constantly evolving, and what worked before may not work now, making it a risky basis for prediction. Reason 10. Market manipulation by big players. Large institutional investors, hedge funds, and even governments can manipulate the stock market through massive buy or sell orders. These entities have the power to move the market in their favor, making it nearly impossible for the average investor to predict short-term price movements. When big players manipulate the market, they can create misleading signals that trick smaller investors into buying or selling at the wrong time. This makes it difficult to distinguish between genuine trends and artificial price movements. Without knowing what the big players are planning, your predictions are at a disadvantage. Reason 11. Analysts' predictions are often wrong. Even professional analysts who spend their entire careers studying the market are frequently wrong. Their forecasts often miss the mark, especially during volatile periods. Studies have shown that, on average, analysts' predictions are only slightly better than a coin toss. If the experts, with all their resources and access, can't consistently predict the market, what chance does the average investor have? Relying on analysts' predictions can lead to misguided decisions and missed opportunities. Instead of trying to time the market based on expert opinions, focus on long-term investment strategies. Reason 12. Unexpected black swan events. Black swan events, like the 2008 financial crisis or the COVID-19 pandemic, are rare, unpredictable occurrences that have massive impacts on the stock market. These events are often outside the realm of normal expectations and can cause rapid and severe market disruptions. By definition, black swan events are impossible to predict. They happen suddenly and have a disproportionate impact, rendering most predictions useless. Even the best-laid investment strategies can be upended by these unforeseen events, making short-term predictions extremely unreliable. Reason 13. Herd mentality leads to unpredictable trends. Herd mentality is when investors follow what others are doing instead of making decisions based on their own research. This can cause irrational market trends, like bubbles or sudden sell-offs that are impossible to foresee. When the herd moves, it can push the market to extremes, either inflating prices way beyond their true value or crashing them to unsustainable lows. Predicting when the herd will move and when it will turn is nearly impossible, making it risky to base predictions on seemingly obvious trends. Reason 14. Short-term market noise masks long-term trends. Short-term volatility often overshadows long-term trends, making it difficult to see the big picture. A single day's news can cause a massive swing in stock prices, creating noise that distracts from the underlying trend. Getting caught up in short-term movements can lead to poor investment decisions. You might sell a stock in a panic due to temporary market noise, only to see it recover and grow in value later. This focus on the short term makes it hard to predict where the market will go over time. Reason 15. Market cycles are irregular. The market goes through cycles: bull markets, bear markets, corrections, and recoveries. While these cycles are predictable in the broad sense, their timing, length, and intensity are not. Trying to predict exactly when one cycle will end and another will begin is extremely difficult. Market cycles don't follow a set schedule, and external factors like government policies, interest rates, and global events can extend or shorten these cycles unexpectedly. Because of this, it's nearly impossible to time the market perfectly. So there you have it, 15 reasons why predicting the stock market is nearly impossible. The stock market is influenced by countless factors, both rational and irrational, that interact in complex and unpredictable ways. Instead of trying to time the market, a better strategy is to focus on long-term investing, diversification, and staying disciplined. If you found this video helpful, don't forget to like this video, subscribe to the channel, and share it with someone who might be tempted to make risky predictions. Thanks for watching, and I'll see you in the next video with more money in your pocket.